to the Northwest Gas Association, and I want to talk a little bit about the takeaways from that 2019 webinar, which I believe was in December. So I ended that presentation with household consumption is the key to no recession in 2020, and actually it's basically collapsed. Second takeaway was even if households don't falter, GDP growth is expected to slow in 2020, and in fact, it actually collapsed. Inflation remains in check in 2020, but are there more downside deflation risks? And the answer is, for sure, now there is. I also said that central banks would be on hold after several rate decreases, but it would be data conditional. They're definitely not on hold anymore. And in fact, rates are down to zero in terms of the main benchmarked rates of the Bank of Canada and the Federal Reserve. And the last was regional growth was expected to slow. Like GDP, it's basically collapsed. So let's start by taking kind of a global look at what's happening to growth. And what this is a distribution of growth across approximately 190 countries, right? And this comes from the IMF. And it's looking at, again, the distribution of growth that we had in 2019 versus what the IMF was forecasting in April for 2020. And so what you can really see is a big downshifting of global growth across countries. The red line reflects the 2020 forecast across those, again, 190 plus countries. Unfortunately, what happened yesterday, and things keep changing pretty rapidly, was the IMF actually downgraded its outlook, in particular for the US and Canada, from -6%, which was their April 2020 forecast, to now in their June forecast, -8%, and for Mexico from -7 to -11%. And certainly from their perspective, North America, the outlook for North America is deteriorating. And in fact, if you look at that red line there, the thing that's important is that what's pulling us down and to the left there are really the developed countries. And so if you look at the growth prospects, especially the larger ones, it's really not very good for the coming year. They seem to be the ones that have been hit the hardest by the COVID shock. If we focus just a bit more on GDP in Canada and the US, and that's what this shows. So we can see that up to the COVID shock, both Canada and the US were growing around 2% a year in terms of real GDP. The consensus forecast for this year, and what that is an average across many different forecasters, is Canada will be -7% and the US will be -6%, okay? Now, what's interesting is a few months ago, there was a pretty wide distribution as people struggled with coming up with a forecast for this year for both the US and Canada. But what we're finally starting to see, though, is the forecasts are starting to group in that 6 to 8% range for 2020. What remains very speculative, though, is 2021. There are still some people thinking we're going to have a V-shaped recovery, but the truth is that's starting to shrink, with the majority of people thinking that we're going to have a Nike swoosh-shaped recovery, something much slower than a V-shaped. In fact, the Wall Street Journal did a poll recently, and 70% of their economists that they survey for forecast think that it will have more of a swoosh-shaped recovery than a V-shaped recovery. And we're also starting to see a little bit more people thinking that maybe a W-shaped recovery is possible, especially if we get a second wave of the virus. Okay, so if we look at 2020 again, what we've essentially seen is a collapse in consumption, a collapse in investment spending, okay, which was not helped by the way, by the collapse of oil prices, and a collapse in trade activity, which we're also going to talk about in a minute. Okay? The only thing right now that's really supporting GDP growth is probably government spending aided by massive amounts of transfer spending in terms of enhanced unemployment benefits and this kind of thing, right? Now, in particular, some news that came out today, and it's something that I think a lot of countries are going to have to deal with, is that Fitch the rating agency, one of the big three rating agencies, actually has downgraded Canadian government debt. The credit worthiness of Canada has gone from AAA to AA plus from the perspective of Fitch. It'll be interesting to see how the other rating agencies also treat Canada, but not just Canada, but the US and other big countries that are now running massive stimulus deficits to try to deal with the COVID shock. So that's something to keep your eye on. So let's talk about trade for a minute. This is incredibly important to the Pacific Northwest, and the data is very much not in favor for the Pacific Northwest, and that includes BC and Alberta. This graph shows year-over-year merchandise export growth, and what you can see is it essentially has collapsed. For the Pacific Northwest, this is going to be a big problem in terms of having any kind of V-shaped recovery, because until trade recovers, right, it's going to be very difficult for the Pacific Northwest to recover in any kind of rapid way, right? To make matters worse, you now have the Trump administration talking about tariffs again, and if that materializes, it will just simply deepen the recession that has come out of the COVID shock. Okay? What we really need to see is an easing of trade tensions, okay? A recovery in oil prices, and countries to start to trade with each other again, and that would certainly aid in the Pacific Northwest recovery.
Grant, I do have a question for you.
Okay.
Any perspective, and you may get to this later in your deck, any perspective on the shape of recovery for different sectors, such as housing? The National Home Builders Association is currently saying they expect a more of a V-shaped recovery in the housing sector.
Yeah, that's a good question. So I would say probably housing might be the one exception where we do see a bit more of a robust recovery. So even in my own work for Avista, I follow permitting in our service area. It's weekly. It's a weekly service from Construction Monitor. And I have been very surprised that the COVID shock barely slowed permitting, either residential or commercial. So, I think it is possible that they may escape the worst of this based on what I'm seeing through permitting. The other thing that I think has really helped the housing side has been this rapid decline in interest rates, essentially down to zero short-term rates. And we're going to talk a little bit about long-term rates later on in the presentation. So I do agree that housing is perhaps in a little bit better shape to weather this. But again, it kind of remains to be seen, because if we have a second wave of the COVID and we have to shut down again, that may put the kibosh on a rapid recovery in housing.
Thank you.
You bet. So again, central bank policy rates, what I discussed at the beginning is that, 6 months ago, it looked like they were on hold. And you can see both the US Federal Reserve and the Bank of Canada have lowered their main policy rates down to zero. The Fed has so many programs now. I like to joke that the only thing that they're not willing to buy is aluminum cans, right? So really, the prospect, I think, for both Canada and the US is that rates will be near zero. These short-term policy rates will be near zero really well into 2021. And if there are to be any interest rate increases, they will be incredibly gradual, just like we saw coming out of the Great Recession. Now, looking at longer term rates, there's this whole interesting debate going on right now about whether or not central banks are going to go negative. Okay? And in particular, the emphasis is on nominal rates. But it's important to understand from the perspective of an economist. Economists tend to think what really matters are real rates. That is, the nominal rate less expected inflation. That's what economists argue really matters in terms of investment decisions. Okay, so what this graph is showing you are the 10-year rates in the US and Canada. And as I've explained in past presentations, they're highly correlated over time. They move together over time just because the US and Canadian economies are in fact so closely integrated. And we can see that along with short-term rates, 10-year rates have come way down. These are incredibly low rates. But the important point is we have the discussion about negative rates. The truth is we've had negative real rates for quite some time, certainly in the US, and I suspect it's been the same in Canada. That dotted line that you can see in the graph, that's an estimate from the Federal Reserve, okay, of what the real US 10-year rate is. And you can see that actually went negative in the summer of 2019. So to me, the debate about whether or not we're going to see negative rates, we're already there if you think real rates are the important driver of investment. And my guess is that real rates will be negative all along the yield curve up to the 10-year for quite some time. Now, this leads into a discussion about inflation then, as we talked about the idea that real rates are nominal rates minus expected inflation. You know, it's sort of interesting. I'm surprised that anybody is forecasting any inflation this year, but if you look at the consensus forecast average for Canada and the US, that's again looking across many different forecasters and averaging, 0.6 for Canada, 0.8 for the US, with a pretty sharp recovery in prices, or that is inflation, in 2021. Again, just like with GDP, I think at this point, 2021 is highly speculative. It's entirely possible that we'll see deflation this year. If you look at month-to-month changes in the consumer price index in Canada and the US, we're already seeing a bit of deflation. And so the big question is whether or not that continues for the rest of the year, or we begin to see some recovery in prices so that we actually get positive inflation in 2020. But the main, yes.
Quick question, this is actually a question for me, is that deflation that we're seeing currently, is that driven like by the energy sector, the crash in oil prices and the like, or is that absent that?
Yeah, so even if we hadn't had the COVID shock, that sharp decline in energy prices would have had a big impact on consumer inflation. And so consumer inflation would have been depressed anyway. But we now have two effects. We've got the collapse in energy prices, but we've also got a massive reduction in demand. There's been a lot of demand destruction. So you have those two things really putting a lot of downward pressure on prices. Okay, add into it the collapse in trade. You know, I just wouldn't be very surprised if we saw, like we did in 2009 in the United States, where inflation for the year was actually slightly negative. You know, at this point, if you look at both the Bank of Canada and the US Federal Reserve have a target inflation rate of 2%. Keep in mind, they struggled to keep inflation near that target when we were growing. I think the prospect of them being below that target for 2 to 3 years is not unreasonable. Dan, does that answer your question?
Yeah, thank you.
You bet. Right. So, you know, what's interesting though, it is interesting to read the press, in part because of the fiscal and monetary stimulus we've had. You still have some hyperinflation aficionados, I like to call them. These are people who think that just like we saw in 2008, 2009, that this massive intervention will be inflationary. You know, the problem is I'm not really with them on that because, again, there's been so much demand destruction. It's very hard for me to imagine we're going to get rapidly accelerating prices. Okay. If we focus more on the region, and I want to spend some time talking about employment, there's a lot of emphasis on employment. There's a lot of emphasis on the unemployment rate, but I would argue there's some nuances we have to really pay attention to, I think, as forecasters and as watchers of the economy. So what this graph is showing is what was happening in the US, California, and I always like to show California because they're just a major player on the West Coast. You know, from Mexico all the way up to BC, it's important to know what's happening in California, just like it's important to know what's happening in Alberta, right? So we've got the blue line is California, the red line is the Pacific Northwest, the US, Washington, Idaho, and Oregon, and then the black line is the US, okay? And so really, the Pacific Northwest was really having a great 10-year expansion, 10-year plus expansion. And that's why I call it the flight of Icarus. And so if you look at the April year-over-year numbers, you can see how far we've actually fallen compared to where we were during the previous expansion. Okay. The US is down minus 13%, and this is really the low point. Pacific Northwest was down 12%, and California was down minus 13%. Now, normally in this kind of presentation, I would also talk about what's happening in metro areas, both major and small. But because this was a simultaneous hit, they all look about the same. Most of those urban areas, both large and small, are seeing double-digit declines in employment as of April. Now, the May data actually has come out, and we can look at the May data and see that on a year-over-year basis, the decline is not as big as what we're seeing here for April, although it's still double-digit. And this is really what I want to say is a cautionary issue going forward, is that both in the US and in Canada, a lot of the statistical agencies are actually struggling to calculate this data. The shutdown, the disturbances created by the shutdown is making statistical accuracy more difficult than it has been in the past. And one thing to be aware of, we could see going forward some pretty big revisions. And so we need to just be aware of that as we see the May data that looks a little bit better. My advice to you is not to get too excited. It still doesn't look very good. And these statistical agencies are struggling to keep pace with, again, statistical accuracy, both here and in Canada. But generally speaking, the situation is pretty bad. Now, one of the things I want to talk about is this whole issue of unemployment. So unemployment is double digit, both in the US and Canada. A lot of people are focused on what's happening to the unemployment rate, and they really want to see that come down. But what I want to tell you is that that's not the only problem we're going to have going forward. Just because the unemployment rate is going down doesn't mean that we're in the clear, because one of the problems I think the US and Canada, and certainly in the Pacific Northwest of the US and Canada, is going to have going forward is underemployment. That's people who are back to work, which would lower the unemployment rate, but they're in a prolonged period where they would like to work full-time, but they can only work part-time. I think that's going to be a real problem in the recovery, and I think that's going to slow the pace of the recovery going forward. Okay. Other issues we need to worry about, so as to we don't get too optimistic, we have to worry about a second wave of the virus, and we're seeing as states open up, the virus surge that could also draw out the employment recovery and reduce the pace at which unemployment goes down, including underemployment. What we're seeing is, you have different recovery plans between states, but also there's a growing tension in states, especially in the US, between what governors would like to do and what the legislature would like to do. And that in itself might create some problems in how the recovery progresses, as you have political fight about who has control of the different phases of reopening the economy. The other issue, and this doesn't get as much press as it should, but it's actually starting to get some press, is that in the United States in particular, we're going to have to confront a massive fiscal crisis, both at the state level and at the local level. That in itself may actually draw out the recovery as well, as states are going to have to grapple with cuts versus tax increases in trying to balance their budgets. It's a big problem. I think it's bigger than what people have recognized. And I think people are only coming to grips with the struggle that states and local governments are going to have in terms of balancing budgets. Now, if we focus on Canadian employment growth, it's really the same story. I mean, everything I just said about the US really kind of applies to Canada as well. And so you can see Canada in April was sort of their low point, minus 15%, BC minus 16% year over year, Alberta minus 16%. The May numbers are out for Canada, and again, you get to see this little bit of a rebound occurring. But just as I said with the US, it's just too early to tell, so let's not get too excited by a little bit of a rebound. The big story, though, that came out, I think it was either yesterday or today, is that BC is now going to move into phase 3 of the recovery. Alberta is still in phase 2. And so it'll be interesting to see how BC performs with respect to the COVID virus as they move into a broader reopening of their economy. And again, that's important because like the US Pacific Northwest, BC has been a real performer in Canada up until the COVID crisis. You know, in 2019, as you can see from the chart, they had 2.6% employment growth, which is incredibly robust. Okay. If we turn to Alberta, which is, as I understand it, they're still in phase 2 of their reopening, and they are in fact really struggling with the COVID virus still. But not just that, they've also been clobbered by the oil price declines. And if you look at the forecast for provinces across Canada, the two provinces that have the sort of poorest outlook are going to be Alberta and Newfoundland. And right now, I think Alberta is probably slightly worse in terms of outlook than Newfoundland is. Alberta is probably going to really struggle. And just like the importance of California, that has big implications for the rest of Canada in terms of what Canada's overall growth rate is going to be. Okay. In addition, they're going to have the same problems we're going to have with this issue of underemployment versus full employment. Okay. And if you look at the outlook for both Canada and the US in terms of employment growth, it's hard to find very many forecasts right now because everybody is so uncertain. Nobody wants to put themselves out there. But in terms of employment growth for both the US and Canada, we shouldn't be surprised if employment growth for this year stays in double digits, negative double digits. And that would also be the same for the Pacific Northwest. Okay. Because again, there's the real possibility that we're not going to have a V-shaped recovery. Okay. The last thing I want to talk about is I want to discuss a little bit about policy uncertainty, because policy uncertainty has a big impact on business and consumer confidence. And this is kind of an interesting, this is a group I love to follow. I think it's incredibly interesting, and I would actually recommend everybody do it. It's the Economic Policy Uncertainty Project. You can actually find it on the web. It's a group of really pretty high-powered academics who find different ways to collect information through the press. And in this case, it's Twitter. Kind of what are people talking about in terms of the economy, and how do you put that in the context of economic uncertainty? And so this is their newest measure, and it's following Twitter. And there's the Twitter-based economic uncertainty, which is sort of a broader index, and the Twitter-based market uncertainty, which is more focused on financial market uncertainty. And what they do is they essentially follow Twitter's, and as it turns out, no surprise, I think something like 2/3 of the Twitter they follow actually comes out of the US, because that's where most people are Twittering, if I can use that word. And so you can see the blue line is the index level, which is 100. Okay, that's where you have a normal level of Twitter-based uncertainty, right? And the base year is 2010 to 2015. And you can see that actually we're already elevated in terms of uncertainty up until we get to March, where Twitter-based uncertainty, both broad and market-based, just goes through the roof. And that represents that kind of twin shock of oil and COVID-19. Now, we can see that it has come down dramatically as governments began to get involved. You had, monetary stimulus, you had fiscal stimulus, but going forward, if we have political leaders introducing more uncertainty, okay, for example, like the Trump administration talking about new tariffs and et cetera, this will elevate again, and once again, that uncertainty will just be another drag on the recovery confronting both the US and Canada. So really what we need to see right now is political leadership that's not introducing a lot of additional uncertainty. It's bad because what people are looking for now more than anything else is a certain amount of certainty. So takeaways from this webinar, okay? And I'm not alone on this mini, and I just want to throw it out there, is the key factor in the recovery is going to be the behavior of COVID-19. Okay? If we have a second wave, that's going to slow things. What we really need is good sampling of who's sick and who is not. It's key to understanding the dynamics of the of the virus and how that's going to maybe impact the economy. Oil price and export recoveries would help, but I would also throw in policy consistency, less policy uncertainty would also benefit the recovery. Okay, there's a lot of talk about there. Will the recovery be V, U, W, square root, or swoosh? Well, right now, as I said, the surveys indicate most people are looking at a swoosh, but a square root, I don't actually think it's off the. But whatever the case is, most people have decided it's probably not going to be a swift recovery. And I say people, I mean economists, and we're people too. And underemployment, and I can't say this enough, is going to be a serious long-term problem, I believe. Deflation risks are back on the table. Even though you have some people talking about hyperinflation because of the stimulus, I think there's been enough demand destruction that the real risk is deflation. Central banks, they're really signaling near zero rates into 2021. And my guess is that's probably not going to change. You'd have to see a dramatic turnaround for them to start raising rates. And the truth is, we really are in a negative interest rate environment already. We've been there some time. If you think real rates are the things that matter. So with that, I'll go ahead and open it to questions.
Any questions for Grant? As a reminder, please use your chat function down, I think either at the bottom or the top of your screen, probably the bottom of your screen. Go ahead and type in a message. We'll give you 20 or 30 seconds here. If I don't get any responses, we'll move on. Have on. So Eric, I got part of your question, but not much of it. Still working on it. Eric, you have one. Can you type it in the chat box for us, please?
And I'm actually having a little bit of trouble getting my chat box to show up, so you might have to translate for me, Dan.
Okay, no problem. Ed Finkley has a question here. Are you aware of an uptick in British Columbia of the virus from the opening as they're opening up their economy?
Oh, I'm sorry, Dan. You phased out a little bit there on your connection.
Okay, sorry. I'll get closer to my microphone. I'm kind of a distance away. Is this better?
Yes, that's better.
Okay. Are you aware of an uptick in British Columbia of the virus as it begins to open up?
You know, I've been reading the news about that, and so far the news about uptakes really centers around Alberta. Apparently, when they went to phase 2 and some restaurants began to open, they began to immediately have problems with the surge in new cases, and so that leaves open the question of how quickly Alberta can open up. In BC, the evidence suggests at this point maybe the problem is a bit more muted. But again, when you begin to open up like that, the evidence from the United States suggests that you should see an increase in cases. The question is it fast enough that you have to pull back on the phase, or is it something you can find acceptable as you let your economy go back to growth? And so at this point, I think it's a little bit unknown.
Okay, I have another question for you. Why does it seem that the stock market doesn't reflect economic conditions?
Well, yeah, that's been going on. I mean, the one explanation is that the stock market is forward-looking. Okay, now that leaves the question open: is what are they looking at? I mean, when I look forward, I see a deserted wasteland, but apparently that's not the case when you're apparently trading stocks. I'm not really sure. I mean, part of it may be that the market is simply misinterpreting the economic data as it comes out. Markets are not perfect. It may simply be that the markets are overestimating the pace of the recovery. And I think at this point, that might be the best explanation of what's happening. But, they are forward looking, but I think the real risk in terms of the market is that they've overestimated the pace of the recovery. And I do worry about that the market has that forward look maybe wrong. The other thing that I think is working in the market's favor, though, is that virtually most major federal governments in the world, most central banks in the world, major central banks, have all signaled they're there to support as long as necessary. I think that's also probably driving some market valuations. The question is have they overestimated the how much effect that support can have in the long run? So yeah, I do worry that the market is perhaps getting ahead of itself a bit.
Another question here. How do negative inflation, negative rates work? I think you referenced
Right,
negative rates a couple of times, real in a real.
right. Well, so real rates, I mean, so there's the debate really going on is we have real negative rates now. Do we need negative nominal rates? And so, that's the debate I think internally central banks are having is should nominal rates, in particular short-term rates, actually be negative so that when you go out and you maybe purchase a short-term government bond, the yield to maturity on that bond, that short-term bond is actually negative, which means in effect, you're basically paying the government for an insurance premium is the way somebody once described it to me, which I think is a good example. And so the argument is if things really start to slide down again, will we actually see not just negative real rates, but negative nominal rates? And the concern about negative nominal rates, in addition to negative real rates, is that maybe it starts to break down financial intermediation because a lot of banks, their business model is based on nominal rates not being negative. And so the question is does that ultimately cause a problem you didn't intend by disrupting financial intermediation? Now, right now, the US Central Bank has sort of said, we don't want to go there yet. But again, they never close the door on anything. It's data conditional. But if they do go that direction, they're going to have to think carefully how that disrupts the traditional financial system, in particular the banking system.
So maybe I've got another question for you, but just to follow on that one a little bit, why would anybody invest in a negative return?
Fear.
Okay. So
And we saw that during the Great Recession. I mean, people became so afraid that they were simply willing to accept a negative rate, a modest negative rate, to have the protection of asset value, in terms of their wealth being protected compared to being in the equity market. So in other words, it's really fear-driven. It's risk aversion. Is it willing to pay a modest insurance premium to the government to essentially protect the basic value of your wealth?
okay, I have another question here. Is there an impact to the Pacific Northwest or West Coast economies with different approaches to COVID containment?
Yes.
Or even say from the west to the east side of our states?
Yeah, this is a big topic of discussion because, of course, as one state opens up and maybe another one goes slower, it still means that if the state that's opening up has an acceleration of COVID infections because of that opening up, there are spillover effects in neighboring states as people from the state that's opening up at a more rapid way basically move around in the neighborhood of the other states. And so, yeah, it does pose some public health issues when you have states on different opening plans. But of course, we have kind of a decentralized government system in the US. And so it's pretty, I think, politically speaking, unrealistic to expect that all states are going to have the same plan. The downside of that is the spillover effects of virus infections as one state maybe opens up faster than the other. And, you tend to start to share the virus at that point.
And have there been economic consequences, or are you seeing any kind of economic patterns from in that context?
It's a bit too early yet. I mean, I think the next 6 months will tell us a lot about whether or not these phased reopenings were a success or a failure.
Okay. Do we have any other questions for Grant? I'll give it just a few seconds here. Okay, Grant, I'm gonna take the screen back.
Okay.
And I want to thank Grant Forsyth for joining us today and giving us a good overview. I got to say, I'm really glad I played the happy song to start with. Um, and because, we needed a little something upbeat. So Grant, thank you very much for your time. We'll look forward to hearing more from you as time goes on.
And
Go ahead, Grant.
sorry, Dan, if people, you can go ahead and post this, or if people would like a copy of the presentation, feel free to contact me.
Okay. As a reminder, so do feel free to contact Grant, or you can contact me, and I'll get you in touch with Grant. We also will be posting this presentation to our YouTube. We've recorded it. We'll be on our YouTube channel. So, the one other reminder I have for you is July 16th, our webinar then, The Art of Listening and the Science of Messaging in a Time of Upheaval by John Davies of Davies Public Affairs. We're looking forward to that interesting presentation. Again, no August webinar. If you all have any suggestions for upbeat songs you'd like to hear as you come into the webinars going forward, please send them my way. I think you all have my email address. And with that, we'll wish you a good rest of your day and weekend coming up. And Grant, once more, we want to thank you for your time today. Thanks,
My
everybody.
pleasure.
Thank you.